Does it sound okay for everyone? Great. I hope you're all well. So I haven't got a presentation this week because I'm just going to be covering volume profiling. So I'll mainly be showing you some stuff on Sierra. So covering volume profiling and how I use it. Is everyone familiar with what a volume profile is? Yeah, I imagine a couple of people will be familiar with it already. It's just another way of visualizing price and volume data, which I think can be really helpful. And for some of you, I think it will click. But even if you don't want to incorporate volume profile into your trading decisions, I think this webinar will still be really useful in just reinforcing or giving a kind of different perspective on some of the concepts I've already covered. Okay. So, I'll first just explain what a volume profile is, just so that we're all on the same page. So, as opposed to volume by time, which is, this down here, okay, volume by time, which you're probably all familiar with, in which price is displayed, or the volume which traded over a specific period of time is displayed on the x-axis. Okay, so how much volume occurred in each bar of time. Volume profile displays the volume by price, so volume on the y-axis. Okay, over here. So it shows you how much volume transacted at each price or over a series of prices, and displays this in a histogram. So it's a little bit like the footprint, in that it records exactly how much volume transacted at each price over a specified period of time. But instead of displaying it in bars like this, in this case 5-minute bars, this is a composite profile, and it just displays how much volume transacted at each specific price over the period of time which is visible to you here. Okay. And if you've ever tried to read up on volume profile, you probably come across quite a lot of information on market profile theory. And market profile was the precursor to volume profile, and it's similar, but instead of plotting volume by price, it's based on time. We'll talk a little bit more about this later on, but I'll just quickly show you what a profile looks like. This is a market profile. Each of these profiles is the equivalent of a daily candle, okay? And here you've just got market profile on the left and the volume profile side by side there. So this is a daily candle. The market profile is on the left, and the volume profile is on the right. And this just shows you how many times during the course of a session price traded through a specific price. Okay, so if I were to split this profile up, okay, each of these letters represent a a 1 hour candle in this case. So the letter A is the first hourly candle in this day. The letter B is the second hourly candle. So you can see how it just records and displays how much time price spent trading at a specific price. Okay, is that clear? And as you can see, they're quite similar in that obviously the more times price trades through a level, the more volume is likely to have traded there, right? Now, as I say, most of what you'll read when you read up on volume profile, and there's really not much out there to be honest, will revolve around day types, which come from traditional approaches to market profile. So, you've got what's called a D type, D day, in which price forms a kind of normal distribution, a range or consolidation, in other words. You've got P-shaped profile or B-shaped profile, sometimes referred to as short covering or long covering rallies, which I'll talk a bit more about later, in which the bulk of the volume is traded at one extreme or the other. And there are trend days in which you've got multiple, usually quite short distributions and little overlap in volume. Okay, so these are the main kind of day types you'll see crop up when you try and read up on market profile. But for me, looking at price in terms of day types and trading them accordingly is just another form of pattern trading. So for me, regardless of the shape of the profile, as always, it's the context which is most important. Okay, it's the liquidity dynamics which I'm interested in. Okay. So, what am I looking for on the profile? You're aware by now that my whole style of trading revolves around identifying areas where I expect price to move through with relative ease, and areas at which I expect there to be liquidity and which I therefore expect to stop price or even cause it to reverse. And volume profile is a great way of just visualizing these areas. So I'm mainly using it for two things. The first is to find potential turning points, and the second is to gauge the market environment, by which I really mean forecast volatility. Okay, so in other words, I'll use it to find areas in which where I expect price to reject, at areas I expect price to run through quickly, and areas at which I expect price to get kind of stuck or spend a substantial amount of time trading. So areas of balance and imbalance. And imbalance, wide-ranging, usually illiquid moves will look like this on the profile. Okay. Very little volume has been traded there. And in contrast, areas of balance or consolidation will often be characterized by a kind of overall resemblance to a normal distribution. So something like this day up here, okay, a D day, right? The bulk of the volume is trading more or less in the middle. So volume's greater in the middle and it tapers off towards the highs and the lows. So if I get the composite profile up and just find a good example, okay. Right, so when price is consolidating like this, okay, or like this, there's relative stability or equilibrium on this time frame, okay. We would consider price to be in balance. And as I explained a couple of weeks ago, it's in ranges like these that the majority of volume is traded, because that's where liquidity is. That's where your larger traders are doing business. Okay, so as a result of the long memory and order flow, which I covered a couple of weeks ago in that webinar on scale, previously executed volume is a relatively good kind of proxy or yardstick for liquidity. So many of the institutional execution algorithms will trade using volume profile, mainly using VWAP, volume weighted average price, as a kind of measure, and they'll use that to execute the majority of large orders where or when the market is most liquid. So it's in these high volume areas, as I've explained, that we can expect liquidity to be pooling, because that's where large or influential participants are getting in and out of positions. And as I've explained, volatility is a function of liquidity. So if traders are willing to provide liquidity in any given area, price will get stuck. Okay, you might think of it as a kind of friction. And if there's no liquidity, a void, usually an area in which little volume has been traded. Okay, over here. Then price is going to run through the area relatively quickly. Okay, price runs through that area relatively quickly, especially if there's some market structure which is going to act as a trigger for an increase in order flow as price is moving into these areas. In this case, these range highs. So, I mean, you know all this already. I'm just going over it to emphasize that the general rule of thumb when looking at volume profile is that price tends to accelerate through or away from areas of low volume and slow down or get stuck at areas of high volume. Are there any questions about that so far? Dave's asking, what are your preferred settings on day one VPVR? Do you use it for finding confluence with levels? The settings are somewhat irrelevant here on the composite profile. I mean, depending on how many ticks you choose to display per bar, you can make this profile more or less high definition, but for the purposes of identifying high and low volume areas, the settings really don't matter too much. Um, so yeah, just fiddle around with them until you find something you're comfortable with. What I'd avoid is the default on TradingView, which is these massive bars. Okay, you want something a little bit more refined like this here. Do you use it for finding confluence with levels? Yeah, I do. I'm going to come on to that later on in the webinar. Okay. Okay. And of course, it's as prices consolidating that areas of high volume start to build. Okay, it's just common sense. And you might have heard of these areas described as high volume nodes or HVNs, which is HVN is something like this. Okay, a high volume node, a build up of volume at a single price or very select few series of prices, and a high volume area or HVA is the same thing, just to build up a volume but over a wider range of prices. So in this case, that this whole range is an HVA or high volume area. And the edges of these high volume areas, so where the volume begins to drop off dramatically, okay, up here, the edges of these high volume areas are of course what people refer to as support and resistance. All support and resistance can be directly tied to a volume profile. So if an SR level is forming, that level will always be reflected in the profile as a ledge, so an area where the volume starts dropping off, or a low volume node. Okay, price or series of prices where very little volume has been traded. So volume profile can be a really good tool for objectively finding and marking out levels without having to think too much, which is one of my kind of priorities as a trader, to simplify the process. So this example, and I just mark out all the low volume nodes here. Okay, just takes a second to mark these out, and they're not difficult to spot. So if I just mark those out, you can see how kind of nice or clean the interaction is around these levels. So support here, support, resistance, support, flips that, support. Okay, support, resistance, flips that, resistance, flips that, support. You get the idea. Okay. So it's a really good tool for finding significant levels. And let's get rid of these. It's worth noting that the low volume nodes will shift depending on how much of the chart you choose to kind of include in this snapshot of price, or as price develops. But these levels remain relatively stable. Okay, excuse me. What's going on here? Okay. Just incorporate more price into the profile, you'll see that the low volume nodes remain relatively constant. Okay, you see that? Okay, so there's more volume building, but the low volume nodes remain, in more or less the same kind of at more or less the same price. And the reason for that is that order flow is persistent. It has long memory, and so these areas which reject price tend to act as a kind of pivots, right? And the same with high volume areas, because there's liquidity in areas of high volume. Price will tend to spend more time kind of rotating around those areas of high volume, so building more volume there. And so what you'll find is that these levels are quite reliable, and so you don't have to be, when you're marking them out, you don't have to be too picky about what kind of portion of price you choose to include in the composite profile, because the low volume nodes are going to remain relatively stable. Okay, is that clear? So I often get questions about, where do you start, looking at the profile from, and the answer is it doesn't really matter too much. Okay, as a result of the fact that these levels tend to remain quite constant. Okay, great. So yeah, if a support or resistance level is forming, that level will always be reflected in the profile as a ledge or low volume node. So here, for example, what's going on here? Okay, and there's another one here. Okay. So here you can quite clearly see where price found resistance, because relatively little volume traded there. Every time price moved up to that level, it got rejected. So when price is kind of in a range like this, I'd be taking note of where that low volume node is, marking it out, and then honing in to find the pocket of liquidity, which is kind of containing or holding price down there, and that's your flag limit. And when price is in a range, it will typically bounce off or reject those levels, those low volume nodes, and move back into what market profile nerds call value. So the area in the middle of the range in which large amounts of volume are being transacted. I'm at a point now where I can quite quickly adapt to different market conditions, but because it's easy to get chopped up when price is going through long periods of consolidation like the one I just outlined, using something like volume profile to help you filter your trades can be really useful. And the reason being is that because liquidity equals friction, we rarely get the volatility we want as a trader when price is in the middle of a range. So areas of high volume therefore represent unfavorable trading conditions for trading on the lower time frames. And so when you get a day like this, okay, which resembles a normal distribution, or a period of time like this here, okay, where most of the volume is being transacted in the middle of the range, what you can do is pull up a profile, daily profile. I'll just do that now to demonstrate. So pull up a, that's market profile or volume profile. It doesn't really matter too much because time spent at price is a relatively good proxy for the amount of volume that's traded there anyway. What you can do is just pull up a profile to kind of remind yourself that you should be looking for opportunities both at the edges, at the extremes, and on a breakout of this kind of ranging market, but not in the middle. You don't want to be trading in here or in here, okay? As I say, this is nothing you can't get from a candlestick chart, and you may already be quite kind of good at recognizing where and when you should be looking for trades, but I find the profile a nice kind of visual reminder, and it can really help keep things consistent for those of you who prefer a more kind of mechanical way of filtering trades. Anyway, this is where the idea of value comes into play. Value is a term which is used to refer to the area in which, in this case, 70% of the volume was traded. And it's just highlighted here. Okay, these white letters here are the value area on the market profile, and in the grey you've got the volume profile value area. And the darker shades are what's considered outside of value. So where that extra 30% was traded on that day. Okay, and where that 70% of volume is trading is usually where the conditions for trading are often undesirable. So it's actually quite a good kind of metric for determining when to be on the lookout for opportunities and when to stay out and wait on the sidelines, because you don't really want to be trading in here in the middle there. Because it's a swimming pool of volume, and it's ripe for chop and misdirection. So when the market's in a range like this, you want to be looking for opportunities outside of value. Okay, up in here, up in here, up in here, up in here, outside of value. Because if price moves out of equilibrium or value on low volume, it's quite likely that price will move back into value. It will revert to the mean. Okay. So generally speaking, when price is in a range, we want to be trading or taking entries around where volume starts to taper off, or at low volume nodes. Or in other words, on interaction with the extremes, anticipating a move back into value, back into this high volume area. And there are a number of different ways you can you can trade this. What I'm usually looking for is, as always, some fresh or untested liquidity up at the range highs or lows, price action on the low time frames, or a false break setup, which I'll come on to next week. But just to demonstrate, the principle here, I'm just going to run through an idea for a very kind of mechanical strategy, just so you can see how consistent this behavior is. And the idea is that when price moves out of previous day's value area, and then comes back into value, we can expect it to move to the other side of the previous day's value area. And one way you can trade this is when price moves back into value, you trade it with a stop above or below previous day's high or low, targeting the other side of the previous day's value area. So if I split this up, you'll just see what I mean here. Okay, this is the previous day's value area high. On this day, price moves out of value. When it comes back into value, I'm expecting price to move to the other side of the previous day's value area, the low, and your stop goes above the previous day's high. Okay, back into value, short it with a stop above the previous day's high, targeting the other end of previous day's value area. And do the same thing here. Okay, where's the previous day's value area high and low? Okay, it moves out of value here. When it comes back into value, long it with a stop below the previous day's low, targeting the value area high. And I think, in fact, this this is 100% win range. Out of value, back in, you're shorting it there, stop above the previous day's high, and that's your target there. Okay, and again here, out of value, back in, out of value, back in, and it hits the other side of the previous day's value area. And of course, this is a very mechanical strategy, which it works really well in ranging markets. But it's not a magic bullet. I'm really just showing this to emphasize the principle that if the market is ranging, you should be looking to fade the extremes, looking to run price back down into where the bulk of volume is trading. Okay, is that all clear? Great. So yeah, for those of you who prefer a more mechanical approach, there's real value in something like this, because it's quite well known that price spends more time ranging than it does trending. But at some point, of course, price will break out in search of liquidity. At some point, the state of liquidity will change. Price will break out of the range. Buyers will overwhelm sellers, or vice versa, either because liquidity just dries up, or as a result of large or aggressive buying or selling, or both. And we don't know when price will break out, but one thing to watch out for is the point of control. The point of control being the price at which the most volume is transacted to start moving away from more outside of value. Okay. So in this example here, the point of control is highlighted here on the profile in orange and on the volume profile in cream. Okay. And you can see on each of these days, it's more or less within the kind of value area for this range. And then on the 6th day, the point of control migrates to the lower end of the range. So down here, okay, areas at which price was previously rejecting. So when you're on the lookout for a breakout, that's one thing to watch out for. Same again here in this small range that followed. Okay, this 4-day range here. You've got 3 relatively balanced profiles here. Okay, point of control is relatively stable in the center. And then on the 4th day, halfway through the day here, you can see that volume is starting to trade, and significant amounts of volume is starting to trade down at the range lows, okay, outside of the previous 3 days value area. And if prices to remain in balance, I really don't expect sellers to be providing liquidity down there, because those are relatively inadvantageous prices. So the fact that volume is starting to build at the lower end of the range suggests that a breakout is imminent. An area we expect to reject price is failing to reject, and that tells us that sellers are becoming more aggressive. They're willing to absorb or get filled at lower and lower prices. Okay, so if I see that the point of control or POC migrating outside of value, I'm usually watching for a breakout, and that's really useful because it can alert you to the fact that you probably shouldn't be fading the range lows anymore. You can also look to take breakout trades, which I'll come on to later. I'll just find another example. Okay, here's one. So again, balance, okay, 4 consecutive days. And then on the 5th day, no significant amounts of volume start trading up at these levels here. Okay, areas at which on the previous 3 days, very little volume traded, because either buyers dried up there or sellers became more aggressive and drove price down. So that's just something to look out for. And when it breaks out, you're going to get imbalance, which looks like this, okay? A low volume area, often referred to as single prints or singles. So a fast, illiquid move in which traders caught on the wrong end of the breakout get stopped out or unwind, and the market has to start reaching to find liquidity. And as I explained in the first webinar, nobody's providing liquidity here. Okay, when the market moves like this, nobody's providing liquidity there. And so price will generally move until it hits some more significant volume. At some point, the buyers or sellers will dry up. In this case, buyers, or price will hit a pocket of liquidity and stall. And then, of course, price will stabilize, or it will range for a period of time before either reversing or moving on up. Okay. And then this is when you get this P-shaped profile. Okay. Very little volume traded at the lower end, and the majority of the volume traded at the top. Or a B-shaped profile in reverse. So a distribution characterized by a long, thin, by which I mean low volume, thin move, and a more well-developed or balanced profile at the top or bottom. And now, whether or not you want to be fading a move like this totally depends on context. But let's get the composite back up again. If price has just broken out from an extended period of consolidation, which will of course appear as a high volume node, high volume area, or HVA, then you should generally be looking to trade with the flow. Okay. So that's a nice example there. Okay. Period of consolidation, price breaks out. After that sharp move higher, you generally want to be looking for and taking trades at this volume shelf here. Okay. That volume shelf there. So the bottom kind of ledge of that consolidation or high volume area, and that's essentially your flag limit. So you want to be taking trades off that with the flow, and that's where your best risk reward is, because it's the last kind of point of reference before this low volume area in here. Yeah, the shelf there, that's where the liquidity is, and if price starts trading into that low volume area, you know that it's very likely going to slip through and fill in the profile there. Let's get rid of that. Other times, of course, this a spike like this is just the result of shorts covering, and so there's unlikely to be any real follow through. And what will happen is the market will stall once the participants who are short have covered their positions, and if the higher time frame flows are still down, price will simply draw back into this low volume area, or LVA, and carry on down. So yeah, when price starts trading below that ledge and into the low volume area, you've got a really nice opportunity to get short, targeting either the singles, which usually appear at the start of the breakout, or the next significant high volume area. Whoops. Another quite nice example here, actually. High volume area. You want to be trading with the flow. Okay, that's your flag limit. That's the volume shelf off which you want to be taking longs there, and your your clue that this might be a short covering rally is when price starts breaking back into this low volume area, at which point it's likely going to trade down to the singles here. Okay, point at which price broke out, or some more substantial volume. So that's how I view volume profile, and how you can use it to kind of gauge the market environment. But you probably noticed that, of course, most of what I've just explained can also be derived from the candlestick chart. It's really just about using what makes sense to you. And for some of you, volume profile might just kind of click or bring a little more clarity to your trading. That being said, the profile can also help you locate levels which aren't readily apparent on a simple candlestick chart. For example, because volatility is a function of liquidity, high volume nodes or the points of control make for really good targets. And sometimes what will happen is the market will appear to stop in the middle of nowhere. And often what you'll find is that if you pull up a profile, there's a high volume node sitting there. So let's see. Okay, if I just mark out the high volume nodes here, again, it doesn't take long to find these and just mark them out. Okay, we'll leave it at that. And we'll just look at how price interacted with the high volume nodes as it ran up this year. Okay, straight through that. No, it did stall there. Okay, and then flipped quite nicely. Price stalls at the next high volume node, the next high volume node, and the one up here as well. Okay, so they're not levels you might otherwise have picked out from the chart, but it's worthwhile having them marked out, because very often high volume nodes can deflect price, especially, as always, if price runs thin into the level. So yeah, it's a good idea to take profits at high volume areas. It's particularly true when trading counter trend in a trending environment. Okay, so let's say we've got something like this. Obviously, these are going to be your high volume areas. Excuse me. You get the idea. And we expect these areas to hold, okay, when price is trending, and for price to carry on up. So yeah, when price pulls back into a high volume area, when you're trading counter trend, take your profits, because yeah, as a result of the fact that you've got resting orders there, right, liquidity tends to accumulate at high volume areas. The point of control in particular will often generate a response. And even if price does end up engulfing those high volume areas, like it does in each of these instances, more often than not, it's at least going to slow down and kind of chop around in there before it starts breaking up. And for me, that's not the kind of price action I like, because it's mentally exhausting, basically, at least for me. So yeah, these high volume areas, and the POC in particular, have a kind of memory, and they're strong reference points in trending markets. So yeah, they're a good kind of structural component to look at for bias. That being said, I wouldn't generally recommend excuse me, wouldn't generally recommend taking trades at these levels. And it's important to stress here that you should not expect the market to stop precisely at high volume nodes. Okay, they'll tend to attract price, and price will trade around those levels. They'll slow it down, and sometimes price will bounce there. Okay, especially if the market's moving quickly. But they are, in my experience, nowhere near as precise as low volume nodes for entries. Okay, of which you can sometimes get really aggressive entries. And I'll use an example I used in the last mentorship just to demonstrate, because it's quite a nice example. Let's see. Okay. And what I'll do is just cover this whole move, marking out both each and right, how price interacts around these levels when it trades back down through them. Okay. So what I'm doing is just kind of adjusting this so that I've got the volume, composite volume profile for this whole up move. And then I'll mark out low volume nodes in gray, like that. And high volume nodes in red. Okay. Something like that, right? So let's see what happens. Okay. Price breaks this low volume node quite easily, which is not unsurprising given that it's just broken out of this 3 or 4 day range. And as I think I've explained in previous webinars, I'm not generally looking to buy prior support levels formed on the way up. Okay, like this one here. I'm not generally looking to buy price support levels formed on the way up if the market's now trending down, because price is seeking buyers, and the buyers at this level have already been kind of consumed. Okay, so generally you don't want to be buying those prior support levels as prices moving back down. So up down here, okay, when price is moving up, that's a level I'd be looking to buy. Okay, that low volume node, but as it moves back down through it, generally I don't expect it to hold. Anyway, what you'll see is that generally what happens is price will stop or slow down and chop around at previous high volume nodes, areas of high volume, this red line here, as it consumes the remaining liquidity there, and then it will flip these low volume nodes. So the low volume nodes are one of the areas where I'm looking for FTRs, okay, pockets of liquidity when price is trending like this. Okay, so price comes down here to the high volume node, consumes the liquidity there, and then it comes back up and rejects off this pocket of liquidity, which is sitting on that low volume node there. So it flips it. Okay. Again, it breaks this low volume node before kind of stalling at the red line, the high volume node there. Just rotates around as it kind of chews through the liquidity there. And then again, it comes back up and finds resistance at this pocket of liquidity sitting on that low volume node there. Okay, so it's flipped the low volume node. And then okay, stalls at this high volume node before finding resistance at the FTR, or this pocket of liquidity, which has just been left behind at that low volume node there. And then it moves quite quickly through this low volume area here. Not much liquidity in there, so that's no surprise. Stopped at this high volume node, and then that's when you get the V reversal. And again, it's not surprising given the nature of this move into the level and the volume build here. Okay, which is usually indicative of some more significant liquidity. So this is generally what I'm looking for when I'm tracking price in relation to the profile. For price to stall at these more voluminous areas, and then to flip prior support levels, prior LVNs. And you can see if I just let this play out a bit that that these levels remain kind of relevant over time. Okay. I've got a couple questions. Glad same James, that line is green. Is it green? Oh, yeah, I'm colorblind. Thanks for pointing that out, though. Okay, so the green line is the POC. Was that clear to everyone? Great. As I've explained, this on the left here is what I'd call a composite chart. So traditional market profile charts are made up of a day's worth of data, but oftentimes you want to see you want to look at how volume has been distributed over a much longer time interval. Okay, and this is where composite profiles are really useful, especially for those of you who have trouble getting your head around scale, because with a composite profile you can get a really good overview of the high time frame market structure, but without having to think too much or worry about time frame, because of course even if you change the time frame here, this is a daily, but it might as well be a weekly or a monthly or a 4-hour chart. Even if you change the time frame here, the shape or distribution of the profile is going to stay the same. So no matter what time frame you're on, it's always clear here where large amounts of volume have been transacted, right? And it's clear where those low volume areas are, regardless of what time frame you're on. So for some of you, I think a composite profile like this can be really useful for getting your head around scale. So here, for example, you can see the market moves from balance to imbalance, balance, imbalance. And this dynamic plays out on all time frames. So whatever the time frame, if price is in a bracket or roughly D-shaped distribution, okay, like this here, a range like this, then you should either be fading the extremes, looking for that mean reversion for a move back into value where the majority of volume is being traded, or waiting for excuse me, or waiting for a breakout into a low volume area like this. Okay, this area here, very little volume has been transacted. Waiting for a breakout into a low volume area and looking for continuation trades, looking to run price up to the next, in this case, the first one is up in here. And you will have noticed by now that large clusters of volume precede big moves, and so it's generally the case that the larger the balance, the larger the imbalance, and that you can therefore expect significant follow through when price breaks out of a range or consolidation like this one here. Especially if the breakout is into or thin an area where very little volume is traded in the past. So when price breaks out of an HVA and into a low volume area, a thin or illiquid move like this, okay, you should always be looking to trade with the short-term trend. So you should expect continuation until price starts bumping up against a more voluminous area. And so you can take trades on the lower time frames. So up in here, for example, at this flag limit, and try and run them up on the higher time frame. So try and run them up to a similarly large volume build. So here it doesn't matter what time frame you're on, the levels are clear. And so I find using the profile it can take some of the confusion out of charting, particularly when it comes to time frame or scale. So yeah, it's a great way of identifying where you can expect the liquidity dynamics to shift, but also of forming some kind of expectation for price. Is that all clear? Great, and I'm aware we've just kind of scratched the surface here, and it's been a bit of a kind of crash course in the profile. But if you want to talk more about this, then you're welcome to arrange a meeting with me, and we can talk more about it. And if you want help getting something like Sierra set up, then I can also help you with that. So yeah, that's all for today. Next week we'll move on to the last month of the program. So if you haven't done so already, please pay by Monday using the link I sent out last week. In fact, I'll send that out later again today, and we'll start by covering false breaks. and trading these is a massive part of my edge, so it should be a good one. And the week following that, we'll come on to the footprint chart, which is going to be a little bit like this webinar in that I've structured it so that even if you're not interested in using the footprint, I'll talk about some kind of nuances, and it should still help elucidate or make clear some of the concepts I've been teaching over the past couple of months. Okay, everyone happy with that? Brilliant. Okay, well, I hope you all have a good weekend. Bye-bye.